In January 2024, Bitcoin ETFs launched and sucked in $50 billion in just 12 months. Wall Street is now putting everything into ETFs, gold, Bitcoin, bonds, even leveraged bets on NVIDIA. But what even is an ETF? And why is everyone obsessed with these three little letters? Let's break it down. Here's the plan. First, what an ETF actually is in plain English. Then stock ETFs, bond ETFs, gold and Bitcoin ETFs. Then the exciting and dangerous world of leveraged ETFs, including single-stock leveraged ETFs like NVDL and TSLL. And finally, how to evaluate any ETF. Let's go. An ETF, exchange-traded fund, is a basket of assets packaged into one ticker that you can trade on an exchange, just like a stock. When you buy one share of VOO for about $530, you instantly own a tiny piece of all 500 companies in the S&P 500, Apple, Microsoft, Amazon, all of them in a single click. It's like buying a variety pack instead of picking individual items one by one. Unlike mutual funds that only price once a day at 4 p.m., ETFs trade on the stock exchange in real time. You can buy at 10:30 in the morning and sell at 2 p.m. if you want, or hold for 30 years. And at most brokers today, you pay zero commissions. SPY, the most popular ETF, trades about 80 million shares every single day. It's the most liquid investment vehicle on the planet. ETFs have exploded in popularity. In 2000, there was just $66 billion in ETFs globally. By 2024, that number crossed $10 trillion, a 150-fold increase. There are now over 3,400 ETFs available in the US alone, covering everything from stocks and bonds to gold, Bitcoin, real estate, and even artificial intelligence. ETFs have become the default way most people invest. Here's the magic behind ETFs that most people never learn. Big banks called authorized participants, think Goldman Sachs and JP Morgan, create and redeem blocks of 50,000 ETF shares at a time. They deliver the actual underlying stocks to the ETF provider like Vanguard and get ETF shares back. This mechanism keeps the ETF price glued to the real value of its holdings. That's why ETFs almost never trade at a premium or discount, unlike closed-end funds which can be wildly mispriced. Now let's go shopping through the ETF aisles, starting with the most popular category, stock ETFs. VOO tracks the S&P 500 at just 0.03% in fees. That's 3 cents per $100 per year. VTI gives you the entire US market, about 3,600 stocks including small and mid-cap companies. And QQQ is the tech-heavy NASDAQ 100, which returned over 18% per year over the last decade. Let's look inside VOO, the most popular S&P 500 ETF. When you buy one share, you own a piece of Apple at 7%, Microsoft at nearly 7%, NVIDIA at 6%, and 497 other companies. The top 10 holdings make up about 35% of the fund. With $527 billion in assets and a 0.03% fee, that's just $3 per year on every 10,000 invested. It's one of the cheapest ways to own the US stock market. And you can buy fractional shares starting at just $1. Here's how 3 popular ETFs actually performed over the last decade. QQQ, the tech-heavy NASDAQ 100, led the pack at over 533% total return. VOO, the S&P 500, came in at 302%. And ARKK, Cathie Wood's Innovation Fund, despite the hype, it's only up 276%, barely matching the Boring Index. All this data is real, pulled from the market as of this year. People agonize over VOO versus VTI. VOO gives you the 500 largest US companies, pure blue-chip exposure. VTI adds small and mid-cap companies for a total of 3,600 stocks. Small caps have historically returned 11.8% annually since 1926, slightly beating large caps. But in practice, the difference between VOO and VTI is about 0.3% per year. Either one is excellent. Pick one and start investing. Don't let this decision paralyze you. Now let's talk bonds. BND holds about 11,000 bonds, US Treasuries, corporate bonds, mortgage-backed securities at just 0.03%. It currently yields about 4.5%. Here's why you want bonds. In 2008, when the S&P 500 crashed 37%, BND actually gained 5%. That's your safety net. But be careful, TLT, the long-term Treasury ETF, dropped 31% in 2022 when rates spiked. Not all bond ETFs are safe. Stick with BND for stability. A common question: how much should you put in bond ETFs? A simple rule is your age minus 20 equals your bond percentage. So at 25, just 10% in bonds and 90% in stocks. At 45, 25% bonds. At 65, approaching retirement, up to 60% bonds. When you're young, you have decades to recover from crashes, so you want more stocks for growth. As you age, bonds cushion the ride. Warren Buffett told his wife's trust, 90% S&P 500, 10% bonds. Gold ETFs let you own gold without storing bars in your closet. GLD tracks the gold price by holding actual gold in an HSBC vault in London. At 0.4% fees and about $218 per share, it's much easier than buying physical gold. IAU from iShares is even cheaper at 0.25%, but be careful with commodity ETFs in general. USO, the oil ETF, lost 80% in 2020 because it uses futures contracts that decay over time. Gold ETFs work great. Oil ETFs, buyer beware. This is the game changer of 2024. The SEC approved spot Bitcoin ETFs, and IBIT from iShares pulled in over $50 billion in its first year, the fastest growing ETF in history. FBTC from Fidelity is another popular option. Why does this matter? Because now you can own Bitcoin in your regular brokerage account, no crypto wallet, no private keys, same tax reporting as your stocks. And Ethereum ETFs launched shortly after. Crypto just went mainstream. Important distinction though, when you buy a Bitcoin ETF, you don't actually own Bitcoin directly. You own shares of a trust that holds Bitcoin. Coinbase acts as the custodian. The pros: incredibly easy to buy and sell, clean tax reporting, no risk of losing private keys. The cons: you pay a 0.25% annual fee and you can't use the Bitcoin for transactions. For most investors, the convenience is worth it. If you want to truly own Bitcoin, you'd buy it on an exchange and manage your own wallet. Sector ETFs let you bet on specific industries. Since 2021, energy stocks through XLE have surged 272% thanks to the oil boom. Tech through XLK is up 121% despite the 2022 crash. And financials through XLF gained 88%. The lesson: sectors rotate. What's hot today might be cold tomorrow. That's why most experts say keep sector bets small, maybe 10 to 20% of your portfolio. And let a broad index like VOO be your foundation. Now let's talk about leveraged ETFs, the most exciting and most dangerous corner of the ETF world. TQQQ gives you 3 times the daily return of the Nasdaq 100. FAS does 3 times financials. SOXL does 3 times semiconductors. When these sectors rip higher, leveraged ETFs can deliver monster returns. TQQQ gained 197% in 2023. SOXL gained 225% that same year. But here's the dark side: SOXL lost 87% in 2022, and FAS dropped 40% during the 2023 banking crisis. These are not buy and hold investments. Look at TQQQ's wild ride since 2020. As of today, TQQQ is up about 294% total, while QQQ is up 178%. Sounds like TQQQ wins, right? But look at the drawdowns. In the 2022 bear market, QQQ dropped about 33%. TQQQ, it cratered nearly 80%. After an 80% loss, you need a 400% gain just to break even. That's the asymmetry that destroys leveraged ETF investors who buy at the wrong time. The ride up is thrilling, but the ride down can be devastating. It gets even crazier. You can now buy leveraged ETFs on individual stocks. NVDL gives you 2 times daily NVIDIA returns. It gained 430% in 2023. TSLL does 2 times Tesla. AMDL does 2 times AMD. And AAPB does 2 times Apple. These let you supercharge your bet on a single company. NVDL has grown to over $5 billion in assets. But here's the thing: AMDL actually lost money in 2024, even though AMD gained about 8%. Why? Because AMD was so volatile that the daily rebalancing ate all the gains. Single stock leverage is a totally different beast. Let us put NVDL and NVDA side by side with real data. Since January 2024, NVDA is up about 189%. NVDL, the 2 times leveraged version, it's up 264%, not double. That's volatility decay in action. Every down day and recovery costs extra due to daily compounding. In a strong directional trend, leverage amplifies beautifully, but in choppy markets, it quietly destroys value. 2 times daily returns does not mean 2 times annual returns. This is the most misunderstood concept in leveraged ETFs. Here's the math that kills most leveraged ETF investors. Imagine a stock bouncing up 5% and down 5% for several days. After 6 days, the stock is barely down less than 1%, but the 3x leveraged version down 6.6%, that's 8 times worse. This is volatility decay. Every time the market chops up and down, the daily reset compounds against you. AMD gained 8% in 2024, but AMDL actually lost money because AMD swung wildly between 120 and 227. The bigger the swings, the more the decay eats your returns, even if the stock ends up exactly where it started. So when do leveraged ETFs actually work? They shine during strong directional trends. If you ride the momentum of a sector or a stock that just keeps going up, leverage amplifies your gains beautifully like TQQQ in 2023. But they fail miserably in choppy, sideways markets where volatility decay eats you alive like AMDL in 2024. And the absolute worst scenario, buying at the top. If you bought SOXL at its 2021 peak, you lost 87%. You'd need a 669% gain just to break even. That could take years, or it might never happen. Before you buy any ETF, check 4 things. 1. Expense ratio. Lower is always better, and 0.03% is the gold standard. 2. AUM and liquidity. Bigger funds have tighter bid-ask spreads, which saves you money on every single trade. 3. Holdings overlap. If you own both VOO and QQQ, you're double counting Apple, Microsoft, and NVIDIA. 4. Tracking error. A good ETF closely mirrors its index with minimal drift. Let's dig into the most important one, fees. This is why fees matter so much. VOO, IVV, and SPY all track the exact same S&P 500, the same 500 stocks. But SPY charges 3 times more than VOO, and the average actively managed fund charges 22 times more. On $100,000 over 30 years, the difference between 0.03% and 0.66% is $163,000. Same stocks, wildly different cost. Always check the expense ratio first. Here's a mistake tons of beginners make. Owning both VOO and QQQ thinking they're diversified, but look at the overlap. Apple is 7% of VOO and nearly 9% of QQQ. Microsoft, same story. NVIDIA, same story. If you own 50-50 VOO and QQQ, you have 16% of your entire portfolio in just Apple alone. That's not diversification, that's a massive concentrated bet on one company. If you own VOO, you already own all the QQQ stocks. Pick one broad fund, not 2 overlapping ones. If you're a beginner and want a simple, powerful portfolio, here's the starter pack. VOO or VTI for US stocks, about 60%. VXUS for international stocks, about 30%. And BND for bonds, about 10%. 3 ETFs, 16,000 stocks, 47 countries, 11,000 bonds. Total cost, 0.04% per year. That's $4 for every 10,000 invested. Simple, diversified, and practically free. Let's recap everything. An ETF is a basket of assets you trade like a stock. Stock ETFs like VOO give you instant diversification at 13% historical returns. Bond ETFs like BND are your safety net. Gold and Bitcoin ETFs brought alternative assets to your brokerage. Leveraged ETFs like TQQQ and NVDL can deliver monster gains if you ride the momentum, but they can also destroy your portfolio if you buy at the top or hold through choppy markets. Volatility decay is real. Keep fees under 0.1%, check for overlap, and if you touch leveraged ETFs, have an exit plan. If this video helped you understand ETFs, smash that like button, subscribe, and share it with someone who needs to see this. See you in the next one.